Hello friends, good day to you all. In our previous episode, we have seen some basic principles of insurance. And these basic principles of insurance form the foundation for the entire subject of insurance. In today's episode, we will see regarding how the business of insurance is conducted in India through the regulation, and what are the institutions associated with the insurance industry that are regulated by irdai. Before we start discussing about current insurance industry scenario, we have to see a brief history of insurance in India. For that, we have to go back to 1818, when the first life insurance company was established in India in Kolkata. That was the Oriental Life Insurance Company, and it was established in Kolkata in 1818. And in 1829, Madras Equitable, another life insurance company by name Madras Equitable, was established in Madras, present day Chennai. And after this, till that time there was no general insurance company in India. The first general insurance company was again established in the year of 1850 in Calcutta, and the company was called the Triton Insurance Company Limited. That was 1850. Till that time there was no formal act regulating insurance industry, and insurance industry by and large was regulated following British common law. And it was in 1870 that the British Insurance Act was enacted, and obviously that was also applied to the Indian domain. After this 1870 British Insurance Act, several companies were established in India for conducting insurance business. That was mostly in Mumbai. That was in 1871, Bombay Mutual started in Mumbai, and Oriental Insurance Company again 1874, again in Mumbai, and Empire of India again started in Mumbai in 1897. After the British Insurance Act 1870, the next legislation was done in 1912, the Indian Life Assurance Act 1912. And this was the first act to regulate life insurance industry in India formally. And then following this 1912 Life Insurance Act, the Indian Insurance Companies Act 1928 was enacted. Through this act, both the life insurance as well as general insurance companies were regulated in India, and it allowed for the business data collection by the government. That is, they can access all the data from the insurance companies. Then in 1938, the Insurance Act 1938 was enacted. This is basically consolidating all the earlier legislations into a single act, a comprehensive Insurance Act, and the emphasis was given for the first time the protection of insuring public, that is policyholder protection is given emphasis in Insurance Act 1938, and till date the same act is used for controlling and regulating insurance business in India. And of course, over a period of time several amendments were made to the act, but still the Insurance Act 1938 holds good. Next important legislation is the Life Insurance Nationalization Ordinance issued on 19th January 1956. Through this ordinance, all the life insurance companies in India were merged into one single entity, and LIC formed, that is Life Insurance Corporation of India, formed on 1st September 1956. And at that time, general insurance companies were not nationalized. They were still running in private sector. And through General Insurance Business Nationalization Act 1972, the general insurance companies were nationalized and GIC formed in 1973. And through 70s and 80s, the economy was going down, and then by 91, we were at the door of sovereign default, and that has prompted the Union government under Mr. Narasimha Rao and Mr. Manmohan Singh to take economic reforms, to come out of the low growth rate and then default situation. As part of these reforms, R.N. Malhotra committee was formed, a committee to suggest reforms in insurance sector under the chairmanship of Mr. R.N. Malhotra, who was RBI governor, former RBI governor at the time, was formed in 1993. So this committee has made several recommendations, including allowing private sector again in insurance industry, and forming a regulator for orderly growth and regulation of insurance industry. Many suggestions were made, and based on this committee's suggestions, in 1999, Insurance Regulatory and Development Authority Act was enacted, following which irdai was established in Hyderabad, and thereafter many private players were allowed to participate in insurance industry. This is in a nutshell starting from 1818, when the first life insurance company was established in Kolkata, to the establishment of irdai in Hyderabad in 2000, based on 1999 Act. It's a journey that we have gone through the insurance industry legislation. As part of insurance industry regulation, irdai has allowed functioning of several institutions auxiliary to the insurance industry, and all these institutions are licensed and regulated by irdai. We will see some of these things. The most important auxiliary institution for the insurance industry is intermediaries. These intermediaries work between the insuring public and the insurance companies, providing insurance advisory to the insuring public, and providing distribution service to the product distribution service to the insurance companies. Basically, they also provide post-sale service to policy holders, like hand-holding them during the claim process, and also handling their grievances, coordinating with the insurance companies. All these activities are carried out by insurance intermediaries. Now, the regulator allows different levels of different kinds of intermediaries. The first and foremost thing is insurance agent, and we are all familiar with that. There are lakhs of insurance agents working for life insurance industry, and predominantly life insurance is driven through this agency model. So this basically when this regulator specifies some training and some qualification, some examination to assess their knowledge in insurance field, that is mandatory for obtaining the approval of the regulator for conducting insurance business. Like for insurance agents, there is a mandatory training period and an examination conducted by Insurance of India. They have to pass, and based on that, the insurance company will appoint them as agents. You can say the insurance agent is associated with the insurance company directly, and they represent the insurance company for which they are working. They are allowed to work for one life insurance company and one general insurance company and one standalone health insurance company. After this intermediary insurance agents, the next level of intermediary is corporate agent. Basically, this is also agency. The idea of corporate agent is that there are certain corporates who have clients, several clients, and when they intend to give insurance policies to their clients, they are required to take corporate agency. Like a bank has got a number of customers. They can give policies to their customers. So for that, they have to become corporate agent. Like corporate agent, say you have a travel agent. The travel agent will be providing travel services to several clients, and he may like to issue overseas travel insurance policies to his customers. Then what he has to do is he has to take this corporate agency. Corporate agent is, earlier it was directly appointed by insurance companies, but now they have to register with the regulator, corporate agents. They are allowed to do one life, one general and one standalone health insurance. In addition to that, they are also allowed to do the two special insurers like ECGC and agriculture insurance. So that is the basic difference between an individual agent and a corporate agent. The next level of intermediary is insurance marketing firm. This is quite recently introduced for the purpose of increasing the insurance penetration. This insurance marketing firm is basically an independent entity that works after getting registration from irdai. For this insurance marketing firm, a specific geographic territory is allotted, like a particular district. They can solicit insurance business in a particular district for some period, and at the time of renewal, they can ask for increasing their territory. This insurance marketing firm is allowed to do insurance business with 3 companies, 3 life insurance and 3 general insurance and 3 standalone health insurance companies. That is development over and above the corporate business. And technically, they are not representing the insurance companies. They can switch from one insurance company to the other insurance company under intimation to the regulator. After taking the due approval from the regulator, they can switch from one insurance company to the other insurance company. Okay, so this is a kind of a higher regulation compared to corporate agent. IMF insurance marketing person, they are supposed to have a principal officer, and they are supposed to take professional indemnity policy, and all those things are there. That we will see in detail at a later date. So far we have seen 3 types of insurance intermediaries, that is insurance agent, that is individual agents, corporate agents, and insurance marketing firms. The 4th level of insurance intermediary is insurance broking companies. These are independent companies licensed by the regulator to solicit insurance business. They work independently, and they are allowed to work with all insurance companies in the country, and they are permitted to solicit business anywhere in India. They are also permitted to set up their branches at various places for increasing the insurance penetration. And basically this insurance broker represents the policyholder, not the insurance company. So they advise the insurance policyholder, and they represent the policyholder to various companies, and based on the instructions from the prospective client, they are permitted to solicit quotations from various insurance companies and work along with the policyholder for setting up the various terms and conditions, and negotiate with the insurance companies and work in the interest of the policyholders. These insurance broking companies can be very large companies because they are also permitted to work with the reinsurance companies by taking composite broking license from the regulator, and they are highly regulated. They will be required to have a professional indemnity policy, and they are supposed to have only qualified broker qualified persons to solicit insurance business, and all these details we'll see at in a later episode. How this broking company is functioning, that we will see, because our main purpose is to understand the broking qualified person from the perspective of clearing broker qualified person examination. So far we have seen different types of intermediaries for soliciting insurance business, and there is another set of intermediaries called specialists. So for example, third party administrators. These are also licensed institutions by the regulator. They work in the field of health insurance, providing a kind of back office service to the insurance companies in handling insurance claims. And another set of specialists, they are called surveyors or loss assessors. Basically whatever name they are called, loss adjusters, but they are all basically surveyors assessing loss following a loss causing event for the sake of establishing the quantum of liability and basic liability of the insurance company to make the payment. So these surveyors are licensed by the insurance regulator, and they are classified into ABC categories based on their experience and expertise. They can be individual surveyors, they can be companies, they can be partnerships, they can be anything. Basically they have to undergo the mandatory training and then pass the examination and then register with the regulator for working as surveyors. When we are talking of intermediaries, there is one special category introduced by the regulator, that is web aggregators, what they call it. Because these days a lot of sales is happening online, and a lot of platforms are being created for various businesses. Like you take Amazon and Flipkart, all these things provide platform for all sorts of physical products. Okay. Like when you take a platform called like Bank Bazaar, it provides for banking services to be aggregated online. So similarly, irdai has licensed several people to set up platforms to provide as an aggregator access to various insurance companies and intermediaries to do business on the online business on this platform. These aggregators are licensed and then regulated by the insurance regulator. The next important institution working in this area of insurance is insurance councils. Insurance councils formed based on the provision given in Insurance Act 1938. Basically, it is formed by representatives of all the insurance companies like Life Insurance Council and General Insurance Council. All the insurance companies are represented on these councils. And basically, they work for the development of this insurance industry in an orderly manner by providing suitable suggestions and advisory to the insurance regulator. And they also appoint the insurance ombudsman for handling policyholder grievances. So these insurance councils also act as a kind of self-regulator for the industry by providing various advisory to the insurance companies. Like this appointment of ombudsman is one of the aspects of the self-regulation. We'll see in detail this ombudsman in this episode. This insurance ombudsman is created by the Government of India through their notification dated 11th November 1998. So this ombudsman basically works for the welfare of this individual policyholders by handling their grievances against the insurance companies. So this ombudsman, there are total 12 numbers of ombudsmen appointed with specific geographic responsibilities for them to handle these grievances. It's various locations they are located, and they are appointed by recommendation of a committee comprising of chairman of IRDA, chairman of LIC, chairman of GIC, and a central government nominee. The appointment is done by the insurance council. Okay. Now, these insurance ombudsmen deal only with personal lines of grievances of individual policyholders. The corporate policyholders cannot approach an ombudsman. Okay. Now, this ombudsman deals only with those problems such as premium dispute, policy wording, claim repudiation, delay in settlement, non-issuance of policy document, and these type of only personal lines of insurance, and individual grievances only will be handled by the insurance ombudsman. One important aspect of this ombudsman is the decision of the ombudsman is binding on the insurance company. They cannot appeal against the decision of the ombudsman, whereas it is not binding on the policyholder. If the policyholder is not happy with the decision of the ombudsman, he can always go for appeal. It's not appeal, he can directly approach another forum like consumer forum or a court, depending on his context and situation, his problem. He can approach another institution for redressal, whereas an insurance company cannot. Whatever decision is given by the ombudsman is binding on the ombudsman, because basically ombudsman is appointed by the insurance council with the intent of providing a speedy redressal to the policyholder grievances. Another important aspect we have to understand is about two sections of Insurance Act 1938. The first one is the section 64 VB. It says that insurer liability commences only after receiving the premium. That is, if the premium is not received by the insurance company, his liability does not exist. It's very important because let's say the intermediary collects a check from the prospective policyholder, prospective client, and if he does not deposit the check with the insurance company, if the premium is not realized by the insurance company, and if something happens in between, then insurance company is not liable. The intermediary becomes liable for the loss. So it's very important clause, and it's a duty of the intermediary to advise the policyholders to pay the premium so that the liability of the insurance company will continue. And the second important section of Insurance Act 1938 is Section 41. There are two clauses. Section 41(1), it prohibits any kind of inducement to the policyholder to buy insurance policy, to continue with the insurance policy, and to renew the policy. No kind of inducement can be given by the intermediary or the insurance company. Like you can say, providing a cashback, giving gold coins, and giving holiday tickets. All these things are prohibited under this clause, Section 41(1). Now, Section 41(2) clause simply says that if Section 41(1) is violated, that is, if somebody gives all these inducements or any kind of inducement to the policyholder for buying insurance policy, it is punishable under law. So these two provisions are very important from the intermediary point of view, that is 64 VB and Section 41 Clause 1 and Clause 2. Thank you, friends. With this we come to end of today's episode on various aspects of insurance business, insurance institutions associated with the insurance business. And in our next episode, we will see how a broking company is regulated by the insurance regulator. Thank you.